Good morning, ladies and gentlemen, and welcome to the Q2 FY23 earnings conference call of Gujarat Themis Biosyn Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Dr. Sachin Patel, Director from Gujarat Themis Biosyn Limited. Thank you, and over to you, sir.
All of you, a warm welcome to GTBL's earnings conference call for the second quarter and half year.
Sorry to interrupt, your voice is breaking. I would request you to come in the range, please.
Okay.
So your voice is still breaking.
Is this better?
Yes, sir. Please continue.
Okay. So once again, good morning, everyone. So thank you very much, first of all, and good morning, everyone. I would like to wish you all a warm welcome to GTBL's earnings conference call for the second quarter and half year ended 30th September. I would like to begin by expressing my gratitude to all of you for taking the time out to join us today. On this call today, we have Mr. Rajneesh Anand and Mr. Tushar Dalal, our Group CFO, and of course, Adfactors, our investor relations team. Before we get into the business and financial performance, I would like to share a brief overview of the company and its key developments and our strategic focus areas. Starting with the background about the company. Established in 1981 as a joint venture between GIC, that is Gujarat, Government of Gujarat, and Biosyn, and it became public subsequently in 1984. In due course of time, GTBL established a strong R&D, which enabled it to develop its own expertise in fermentation chemistry. Today, GTBL is one of the few fermentation-based manufacturers of pharma intermediates in India with a robust technical know-how and strong capabilities.
Ladies and gentlemen, please stay connected while I try to reconnect the management. Ladies and gentlemen, the line of the management has been connected. Sir, kindly proceed.
Yeah. Apologies for that disturbance. Let me begin with a little bit of an introduction. Today, GTPL is one of the few fermentation-based manufacturers of pharma intermediates in India with a robust technical know-how and strong capabilities. We have an environmental friendly and sustainable process using aerobic bacteria for fermentation. Our product portfolio grew with rifampicin in 1991 and lovastatin in 2003. Subsequently, the company started manufacturing rifamycin S as an intermediate. During the year, we changed our business model from contract manufacturing to manufacture and sale model. After fulfilling all contractual obligations, we were able to make a strategic shift which has led to improved realizations and substantially improved margins. The success is testament of our superior capabilities and strong processes. With long experience of handling the fermentation process, understanding of intricacies that are involved, and understanding the impact of various variables, we believe that the company is now ready to move into the next leg of growth and innovation. In addition to a state-of-art manufacturing facility in Vapi, Gujarat, we have expanded our R&D base to focus on new product development. As mentioned earlier, fermentation-based process for intermediate development has its own challenges. But with our long experience of product development and making it commercially viable, we are confident and optimistic. I hope you must have gone through the presentation where we have mentioned about a roadmap for development and launch of new intermediates. Also, we plan to move up the value chain and forward integrate in manufacturing API. We announced a 200 crore capex that is spread over the next 2 to 3 years in a phased manner. The plan comprises of developing strong R&D capabilities. Furthermore, fermentation capacities are also being expanded. Herein lies one of our key differentiators, the experience and technical know-how to scale up a new product from lab to commercial level. The new products would address different therapeutic areas, thereby expanding our product and application as well as customer profile. While currently we are catering to the domestic market, with the new facilities and products, we shall be targeting overseas markets as well. Therefore, the new R&D labs and manufacturing facilities would be compliant with various regulatory authorities. Moreover, we are also looking into the possibilities of forward integrating into APIs. On this line, we aim to develop an API block as part of the mentioned CapEx plan. Backed by a strong cash flow position combined with zero debt, we are well positioned to fund this expansion plan primarily through internal approvals with the option to raise debt if and when required. Going forward, we strive to expand our presence in the value chain and overall markets, while we leverage our technological expertise in fermentation to develop new products. A long-standing association with our customers ensures a stable order book. Now, turning to financial performances, I will hand it over to Mr. Rajesh Anand to take us through the same. Thank you very much.
Thank you very much, Sachin Bhai. Good morning to all of you. We will now turn to the financial performance. This is about second quarter, FY23. We reported rupees 47.69 crores in revenue during Q2 FY23, a 36.08% year-on-year. Growth was primarily driven by higher volumes. Our EBITDA for the quarter stands at rupees 24.4 crores, which increased by 32.29% year-on-year. EBITDA margin is 51.17%. It is down by 146 BPS. Our PAT during this quarter is 18.7 crores as against 13.79 crores in the second quarter of FY22. Net profit margin is at 39.21%. Earning per share for this quarter is at 12.87 rupees 12.87 per share. Coming to the half-yearly performance, we reported rupees 92.64 crores in revenue during H1 FY23, a 37.26% year-on-year rise over previous year's first half, Growth was mainly driven by rise in volumes. Our EBITDA for the period stands at rupees 47.18 crores, increase of 34.15% year-on-year. EBITDA margin is 50.93%, a decline of 118 BPS. Our PAT for these 6 months is 36.47 crores as against 26.71 crores in H1 FY22. Net profit margins stood at 39.37%. EPS for the period is 25.10 rupees as against rupees 18.39 in H122, an increase of 36.48%. That is all from our side. We can now turn to questions. Hello? Hello? Hello?
Thank you very much.
Yes.
We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Saloni Himnani from Molecule Ventures. Please go ahead.
Hi, good afternoon, sir. Congratulations on the great set of numbers. Sir, I have a couple of questions. First one being the stake that we acquired from PBG. So, based on the document, the promoters already hold majority of the stake in PBG consortium. So, what was the purpose behind acquiring stake from PBG?
Saloni, I think there is a bit of a confusion. There is no stake acquired by GTBL from PBG.
Let me get back to you in that question, sorry.
Yeah.
Second question is regarding the CWIP, the 10 crore CWIP that we observed in the September results. So, sir, how much out of the 80 crores that we had planned in the AGM, so how much of that has been already spent in the phase 1 capex?
I'll request Mr. Rajneesh Anand to answer this question.
Yes. The investment is ongoing. We have spent about 22 crores till now, which is mostly in CWIP, and the projects are ongoing. In the current quarter, in the quarter which is going on, we will be capitalizing our warehouse and put it to use. The rest of the projects will also continue through the next quarter.
All right, sir. Sir, are we sticking to the quarter 3 of FY24 timeline for commissioning phase 1?
The warehouse part will be commissioned. The R&D center that we were envisaging will initiate in this quarter, will be postponed to next quarter.
All right. And so, what is the current capacity utilization of the existing capacity?
Right now,
yeah, please.
I think right now we have been utilizing almost 95% of the capacity.
Because this quarter we mentioned in the PPT as well that the sales growth was primarily driven by higher volumes. So I'm just trying to get a sense on the leeway we have till the capex is commissioned, basically.
Mm-hmm.
So till the new capex and the new facilities or capacities come in, the volume growth will be limited from our current manufacturing processes which are there, or current manufacturing capacities which are there. But at the same time, we are exploring alternative strategies in terms of how we can bring in volume growth too, not necessarily in the next couple of quarters, but after that.
All right. So let me clarify on the PBG part and I'll get back to you. Thank you.
Sure.
Thank you. We have the next question from the line of Keshav from Raxan Investors. Please go ahead.
Hi, good morning, management. Currently, for the H1, what is the percentage split between RIFA S and RIFA O?
Sir, these kind of questions we would not like to address here because this is all confidential information of the company.
Okay, no issue, sir. And sir, for RIFA O, do we see a secular growth trend going forward? Because in the US, it is still under patent protection, so we should be yet to see generic supplies coming in for that, right? So the volumes overall should see reasonable growth for the years to come. Is that a correct understanding?
Yes,
Yes, typically.
Correct. Yeah, go ahead, Sachin bhai.
Yeah. So typically this is what you would envisage, but we will have to wait and see for the patent expiries to come in at the same time how the tuberculosis market is behaving as the years go by. So yes, one would expect that typically in line with what happens in a generic space, the volumes go up once the patent expiry is there. That should happen like for all other products, but how that will impact the overall RIFA demand is something that we are still trying to figure out.
Sure, sir. And so secondly, I wanted to understand a bit more about our expertise or other companies' barrier to entry when we talk about fermentation. So I'm aware of at least 3 listed players who are foraying into this space. And 2 of them are smaller companies than ours, and one of them has products in the prospect list that include a couple of antibiotics we had filed for in the EC report. So is it that the barrier to entry are more macroeconomic than the technology or the ability to handle itself? Like India used to have a decent fermentation base before China took it out with their economies of scale, lower cost, or utility subsidies. So could you help sort of understand if we bring something more to the table than these newer entrants might, and they would find difficult to adapt to, or is it more a macro trend that will support us as well as the newer players?
So I believe that most definitely the macro trend is positive. So not just us, but there is a good possibility that a fair number of fermentation companies who are in the right space at the right time would do well. That is what we believe. With regards to other companies coming in vis-a-vis us, I would only say that in our past experience there is a significant challenge to scale up. So one may do something at a particular level, starting from lab to even pilot, but then to scale it up to commercial scale and be able to be competitive in terms of the market has its fair set of challenges and experiences required in that. Saying that, obviously we should never consider that other companies will not be able to do it if we are able to do it. So I think anything more than that would be speculative, positively or negatively.
Understood, sir. And sir, so just a follow-up to that. So on the technology itself, if we say foray into a new product, the typical value chain would be in licensing the strain and then developing a process using it, right? There would not be any strain engineering done by us in collaboration with someone. Is that the correct understanding? So our expertise would lie in scaling up and handling these systems?
That's right.
Okay, sir. And sir, lastly, if I may, going forward, would we be equally focused on intermediates as well as APIs? And I mean, so when we start the regulated market supplies, would we have separate manufacturing basis for intermediates and APIs?
So the facilities that we are building up have a lot of flexibility. Product based and at the same time partnership based, we will decide whether we should manufacture the API or the value addition for us or the value proposition for us is best in only manufacturing the intermediate and not the API. So really it would have to be a case to case scenario that we will have to explore.
Sure, sir.
The important bit is that we should have the flexibility of doing both.
Understood, sir. Thank you. Thank you, sir. I'll come back in the queue.
Thanks.
Thank you. We have the next question from the line of Tarun Sanjeti from Sanjay. Please go ahead.
Hi, sir. Good morning. Am I audible?
Yes, you are.
Thank you. Firstly, congratulations on a great set of numbers and consistently reporting very robust profit. Since we really don't get too much of opportunity to interact with management, I would like to clarify a couple of questions specifically from a business economics perspective. So the first question I would have is that, as we know, historically, fermentation industry was under significant pressure from China because of the predatory pricing and the policy benefit that they had. On the other hand, what we understand also is that now that cost advantage is going away because of different prices going up, energy prices going up, etc. At the parallel, China, in some other industries, what we have observed is that will continue to do the predatory pricing even if those policy benefits are taken away. Keeping that context in mind, what is the source of confidence that China threat is entirely eliminated and domestic industry will be able to operate, without such predatory challenges, which were historically part of multiple industries?
So I would put it this way that I think for any of us to be complacent and think that there is no potential threat, be it from China or anywhere else in terms of pricing or in terms of competition, is a bit too complacent. So I think we all need to be wary of that particular front. And hence our future is basically decided not just on the basis of one particular product. We are spreading what we are doing into multiple projects, into multiple products which are there, and with strategies which we hope will sail us through. So basically, if the price of a particular product is suddenly coming down from an XYZ competitor, it should not affect us, at least in the near future, if we have the right kind of contracts in place. So it's a complexity of manufacturing. At the same time, on the business side, I think everyone has learned that steady supplies are more important than going too far up and down and going for spot businesses. So we as a company also are minimizing the amount of spot business that we do. Most of the business that we do is through long-term partners and contractual obligations on both the sides.
Mm-hmm. Thank you. Another question, again, to understand more of a competitive landscape for the industry. Lupin has been a significant and a long-standing customer for us. And what we also understand is that lately there is a change in the business model wherein we moved away from a job work or a conversion work-based model to a spot-based pricing model. In that context, now that the dynamics has changed, what all options a Lupin or Unichem would have if, for any reason we are not able to supply that? And to flip it around, what all options we would have in case, Lupin looks for another source? So I'm trying to understand the overall supply chain dynamics of this particular thing.
I think on both the sides there are no immediate solutions, and that is why the relationships are what they are. I would say that we would not have too many options. I would believe that they would not have too many options. Otherwise, I'm not specifying a particular company, but companies that we have contracts with would not sit on a table and have a contract in place, right?
So fair to conclude that it becomes kind of a mutual relationship and without much of a competition coming in the foreseeable future. Is that the inference here?
I think the first point is, I would say, a sign of a good agreement that it should be mutually beneficial. And if it is mutually beneficial, then the second part hopefully is taken care of if everyone is sensible.
Okay, that helps. Another question would be that, during the last call, management has mentioned about adding a couple of customers. Based on current visibility, what we understand is that Lipid and Optics, which is a Unichem Group company, are the two key customers contributing significantly to the overall revenue. Now, knowing the fact that we are operating at close to 80% of our capacity utilization, how are we looking at adding more customers? And in case a couple of other customers come on board, in the near and immediate future, how we are going to solve that, considering that we are already operating at 80% of the capacity utilization?
As Mr. Rajnish Anand pointed out to a question previously, we are operating at 95% capacity and not 80% capacity. And
okay.
Also we have developed 3 other customers, but they are in very small volume. So that is where things will lie. If we see more demand come up in the future, we will have to plan for it. But at the moment, very honestly speaking, we are not able to speculate what if there is going to be an increase in demand when the patents of rifaximin go off, and how the tuberculosis market will behave. So these are still things that we are working on, basically to see that 2 years down the line whether there is going to be an increase in the Rifa S or Rifa O demand for us.
And the 3 customers that you alluded about, those are customers for Rifa S, right?
Yes, they are customers for Rifa S.
Okay. The last bit of the question I would have, and I can join back in the queue again. Based on some of the regulatory filing, we understand that some of the products are being transferred to Themis Medicare, which is a group company. For example, Alovastan, and also within Themis Medicare, we are building up capacity for Rifa S. So the question is that why is it that we are not looking at augmenting the capacity within Gujarat Themis instead of looking at Themis Medicare?
I think on the first count, it's not correct that from GTBL, Lovastatin is transferred to Themis Medicare. That is not actually accurate. In fact, historically speaking, Lovastatin was transferred from Themis Medicare to GTBL, and it still remains in GTBL, although we are not producing the same for economic reasons. And with regards to Themis Medicare manufacturing Rifa S, that is also not the case. Themis Medicare is not manufacturing Rifa S. GTBL continues to manufacture Rifa S. Themis has its own plans in terms of what it is doing.
Okay. Thank you for taking up my question. I'll join back in the queue. One last submission I would have is that, in some circle, there are some sort of information spread around change in the stakeholder pattern for the parent entity, which is your pharmaceutical business group. I think it would be fair and transparent for everyone to understand our position on that.
Sorry, could you repeat the question? Could you repeat the question, please?
Yeah. So my question is that, there is some sort of a communication or information out there in the investor community about change in the ownership structure for pharmaceutical business group. So in that context, to subside any kind of rumor in the market, a statement from the management is going to be very, very helpful. In case if there is on those lines.
So since we have not heard about this and there is no fact to it, I don't know what we can clarify apart from the fact that PBG owns 51% of GTBL shares, and the promoters of PBG are essentially promoters that we have been for a very long time.
Sure. I think that in itself clarifies a couple of things on that. Thank you again, sir.
Yeah. Okay. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all participants, please limit your questions to 2 to 3 per participant. Should you have a follow-up question, please rejoin the queue. We have the next question from the line of Nisarg Shah from Igloo Enterprise. Please go ahead.
Sir, congratulations on a great set of numbers for H1. My question is regarding the capacities. So one of our peer is coming up with who has already filed for DRHP and seeking almost double valuations than what we trade at. So they were able to generate close to 450 to 500 crore revenue consistently when they had back in the days until 2020 capacity of 450 cubic meter, close to our capacity. But we will be, as I understand, on optimal utilization, we can generate close to 200 crores. So, sir, what is the difference in this asset turns? So, does it depend on like product to product, or can you please throw some more light on that?
No, absolutely. But I would like you to repeat the beginning part of the question because I could not get that very clearly. One of the competitors is?
Yes, one of our competitor who has already filed for DRHP and they are seeking close.
Understood. I got it. Yeah, so they, so I think at the end of the day, the fermenters are fermenters. It depends upon what you produce in it, right? Now, currently what we are doing is we are producing up to the intermediate. We are not manufacturing the API. If we were manufacturing the API, our sales turnover would be higher. If we would be manufacturing the finished dosage form from that, our sales turnover would be even higher. Currently, what we have done is we have seen where the maximum value for us is in the entire supply chain. Not to say that it does not make sense to go ahead, but looking at the product that we are in, we feel that this is where we are deriving the maximum value from the entire supply chain. I think for that particular reason, perhaps our EBITDA margins are perhaps higher than the other companies also if you look at percentage-wise. But if you consider what is the best way to utilize capacity and your whatever 450 cubic meters that you have, I think in a way that depends upon the product that you pick. Now we have picked this particular one. The capacity has been designed. The facility has been designed to manufacture this particular product. So if they wanted to come in and they wanted to produce this product, it would not be so easy for them to do it in the same competitive way or same kind of margins that we do it with. And if we wanted to do what they do, we would not be able to do the same for multiple reasons. So I think it's just the place that we all are in. And obviously going ahead, they would plan many other things like we would in terms of how to get the maximum profitability and returns in terms of the investments that we are making.
Sure, sir. That was quite helpful. And one more thing I wanted to know, are there any plans on getting listed on NSE? Because given that we are now almost close to more than 1300 crore market cap company, but there is barely any liquidity because we are only listed in BSE.
So I think we have to fulfill one criteria of NSE, which because of historical reasons we were not being able to fulfill, and that is that the net worth of the company has to be over 100 crores for 3 consecutive years. I think our third year gets over next year, after which we should be most definitely listing on NSE.
Sure, sir. That was quite helpful, sir. All the best. Thank you.
Thank you. Thank you.
Thank you. We have the next question from the line of Darshit Shah from Nirvana Capital. Please go ahead.
Yeah, so thank you for the opportunity. Sir, can you briefly tell us, since you ended the tie-up with Yuhan Corporation and then we have seen a jump in revenue and obviously our margin. So was that earlier we used to only kind of recognize the profit share of the contract manufacturing in our revenues, and henceforth when we start to sell it on our own, that is the reason for the bump up in revenues as well as the margin?
Sorry, is your question related to why we shifted from contract manufacturing to business to sale purchase, or is it related to Yuhan? I'm a bit confused. If you could just clarify for me, please.
Yeah, so why we kind of shifted, and earlier were we kind of recognizing in our revenues only the profit part of what we used to do in contract manufacturing, and hence now we have changed the business model itself, and thus we are seeing a bump up in revenues as well as profitability. If on both the points you can clarify.
So previously, when we were working on contract manufacturing, it was a cost plus model. So whatever our costs were, on top of that, there was a fixed margin per kilo on the basis of which we were transferring the goods, and that was our contract previously. And subsequently, we decided that we wanted to move from that to a sale purchase model, which increased the risks for us, but also increased the rewards, on the basis of which we moved into a sale purchase agreement. So that was one part. That was one part of it. The second question was with regards to Yuhan. Yuhan was not, so when this particular cooperation started, Yuhan had a lot of interest in fermentation, specifically rifampicin and many others too. But with time, they exited the fermentation business. So them being a partner at that particular time was while it's interesting, subsequently it wasn't of interest for them nor for us to continue that relationship going ahead, and hence the exit took place.
Got it. And so my second question is on the newer capex of 200 crore which we are doing. So two questions on that. When is the kind of capacity going to come up for commercial on this capex? And secondly, if you could highlight a little bit more on what kind of products are we looking at in to manufacturing the newer capacity, and kind of are they kind of import substitute, or how is the competitive intensity of those products which we are envisaging to make in the newer plant?
So as we have said, the capex plan is spread over 2 to 3 years. Our period started from the beginning of this particular financial year when we made this particular statement. In terms of capacity increase, the first capacity that will increase, which will be in the next financial year, will be of the API block. The API block up and running going ahead. And subsequently in the following year or by the end of the year, the fermentation block will also take place. But in terms of how soon we can start using these particular capacities will depend upon regulatory approvals too. So I would say that by the end of next year, we will start using the API facility, and the year after we'll start using the fermentation facility.
And sir, if you could throw some more light on the products and the competitive intensity of those products which we are envisaging to make in the newer plant.
So that is something that we have actually not put out in the public domain for reasons of confidentiality. Obviously, the product selection is made in a way whereby we don't really want to look at products where there is too much competition, if any, because having a crowded marketplace essentially means lower margins, which is not our endeavor. So we are very careful. We may have a dozen products in development, but we are very careful with what we take commercial because sacrosanct is to make sure that the profitability remains in a good shape.
Awesome. Thank you.
Thank you. We have the next question from the line of Jainam Gilani from Moneybee Investments. Please go ahead.
Hi, sir. Congratulations for the great set of numbers. So I just wanted to know, how are we planning to fund the capex of 200 crores? What would be the debt to equity mix?
So as we have put out in various calls, we are expecting most of the capex to be funded by internal accruals, and if it is then required, we always have the option of debt. Touch wood, at the moment, we don't have any debt on our balance sheet, and and we have a reasonably good cash surplus.
Thank you, sir. And so what would be the revenue that can be expected from this capex? Like, what can be the FA turn we can expect from the 200 crore capex?
So the project that we are looking at, I would rather than talk in terms of revenue, I would say that the payback period that we are calculating is 3 years, 3 to 4 years.
Okay. And so what would be our sustainable margins, if we can say, for the next 2 to 3 years? Can we maintain these margins, or?
I wish I could tell you that we can maintain the margins or even grow them, but that would be an indirect way of you asking me what is the pricing going to be tomorrow or day after. So that would be a bit of a speculation from all our ends. So we hope that the margins will remain at the level they are, but it would be impossible to say that it will definitely remain the way they are tomorrow. But we all hope for the best and work towards the best.
Thank you, sir. Thank you.
Thank you. We have the next question from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
Sir, thank you for providing this opportunity. Sir, I wanted to understand that since we are already at 95%, sir, so can we go above 100% through some debottlenecking over the next few quarters, or 100% is the maximum that we can go to?
I think it's a good question. While we are working and we are trying to put all our efforts in terms of what is the maximum that is possible, I cannot tell you right now if we have something concrete on the table. But it is, like all manufacturing activities, all manufacturing processes, you continuously try and get to better and better. But I don't have anything too positive to say at this particular time that we have cracked something that will enable us to increase this capacity.
Sir, and since in case we are unable to go beyond 100%, which normally isn't possible, so in that case, for the next approximately 8 quarters, so since the growth in volumes will be limited, so can't we increase our pricing since we have limited capacity? So I mean, is it possible that we can increase our pricing and thereby increase revenues in the meanwhile?
I don't envisage price increases at this particular stage. As I said during one of the previous questions that was asked, we are on both the sides bound by contractual obligations, which we intend to very much stick to. But over the next 8 quarters, we are working on a strategy in terms of how we can grow, even though fermentation capacity will take longer in terms of coming into effect. Let's not forget our API capacity comes into effect next year. So that is something that should definitely increase our top line and hopefully bottom line too. And at the same time, we are working on multiple strategies in terms of what more we can do, considering the fact that we will have significant API capacity which is going to be commissioned.
Okay, so thank you very much.
Thanks.
Thank you. We have a follow-up question from the line of Saloni Himnani from Molecule Ventures. Please proceed.
Hi, sir. So just one question on my side. So Themis Medicare acquired stake of GTBL from PBG, 6.47%. So I just went and checked the promoters currently own majority of the stake in PBG. So I just wanted to understand the rationale behind the promoter company selling stake to a listed Themis Medicare. So can you just throw some light on that?
So one particular thing is, so now factually you're right, but again, this is something which has changed. So from a GTBL's perspective, it's got nothing to do with GTBL, as you can imagine, right?
Right.
It's not a GTBL operational question. But you're more than welcome to come to the Themis Medicare earnings call and ask the same. But nevertheless, since it is in the public domain, it is very simple that this particular matter was then subsequently withdrawn, and that Themis Medicare is not acquiring the shares of PBG.
Okay. All right, sir.
From PBG, not of PBG, from PBG.
Got it, sir. Thank you.
Right.
Thank you. We have the next question from the line of Aman Viz from Astute Investment Management. Please go ahead. Mr. Viz? Yeah, please proceed.
Yeah, sir. So my question is on this API facility. So is it the forward integration of the current two products, or is it for new products altogether?
So it is a multi-purpose block that we are building. As you can imagine, there are quite a few APIs which are there in the market where fermentation intermediates are required. So the idea is, while we build up our fermentation capacities and capabilities for all these intermediates, we can most definitely start by producing these APIs from sourced intermediates to begin with. So that allows us faster entry into the market, and that is what we plan to do. And since it's a multi-purpose block, it gives us a lot of flexibility in terms of what and how we want to use this facility to get more sales and more profits, obviously.
Sure, sir. And the timelines you mentioned is Q3 FY24 now of this API block?
What I will do is I'll ask Mr. Rajnishan to clarify this particular bit of question.
Can you please repeat your question?
Sir, when will this facility come online? Is it Q3 FY24 or Q2 FY24? This API block.
I think end of Q2 FY24.
Sure, sir. And given this is a API facility and a multi-purpose plant, how long do you think it will take to fully utilize it? Is it like 2 quarters, or it will take time? And also the margins, because it is not the intermediates, and you mentioned earlier in the call that the margins in intermediates are much better. So is it safe to assume that margins here will be maybe like 10-20% lower compared to our current margins?
Yeah, the margins, one cannot expect the margins to be in line with what we are doing in fermentation. So the objective is that we get faster market entry for some of the products that we are working on in terms of fermentation. That is one. And the second, which is your question, was how soon do we expect capacity utilization? Very difficult to answer that particular question, because it's like a new company starting, and it's a step-by-step process in terms of how capacity will be built up. But what one can envisage is that quarter on quarter there should be increase in sales and profit coming from that capacity that we are creating.
Sure, sir. My final question is on the new products and new customers. So you mentioned that the 3 new customers we have built are currently having lower volumes, since most of the volumes are occupied by the top 2 customers. So will these 3 players, the volumes will go up once the API facility comes in, or only when the fermentation block, which will take maybe much more time, will come in? That is one part. And the second part is in terms of newer customers, are we planning to add in the next 2-3 quarters? And new products also, you've not mentioned the name, obviously, because of confidentiality. But in new products, most of these three to four products you had mentioned will come in the API part or the fermentation part? These are the 2-3 sub questions I had.
So let's take the questions one by one. I think there are 3 questions that I heard over there. One is we've got new customers come in, and how much quantity we'll supply to the 5 customers now will depend upon how the contracts are being negotiated in the years to come. So this gives us enough flexibility in terms of how we would like to operate and what gives us the best contract on the table, which company gives us the best contract on the table. So that is the reason why we have gone out and we have done this. In terms of preference over one company to another, there is none. With regards to the products that are going to come out, obviously in the beginning, the products which are going to come out are going to be from the API block, because that is the API block that is the facility that is commissioned before anything else. In case of fermentation, a lot of products we expect will be filed from the GMP pilot that we have planned and will be commissioned in due course of time. So that is where the fermentation filing will take place, and then subsequently commercials will happen once the entire capex is put into place.
Sure, sir. Sorry, one clarification. The 3 new customers, are they big enough, or are their demand, do they have volume requirements enough in case we want to shift the major portion from the current 2 top customers? Is there a requirement enough among the other three players, or are they much smaller players?
I think that we have good partners currently. So I don't think it is going to be our endeavor to replace them. But at the same time, we would like to have certain amount of supplies going on over there, as generally one would in a business, right? You want to make sure that you have spread your quantities around across customers. So that is what we are doing.
Sure, sir. That helps. Thank you.
Thank you. We have a next follow-up question from the line of Keshav from Vaccine Investors. Please go ahead.
Sir, the volume growth we've seen in H1, could you please give some qualitative insight if it was more driven by the rifaximin intermediate? Because the rifaximin is still going well, and rifampicin is a fairly mature product, and we are also seeing rifampicin-resistant pulmonary tuberculosis cases rising. So if you could just give some directional view of things, that if the growth we are seeing is driven majorly by rifaximin, would be great to sort of allay any fears.
So I think rifaximin is definitely doing well, but I think rifa is also doing well. But there is, if you look at our last year, and even perhaps the year before, there have been a little bit of variations from one quarter to another quarter, because tuberculosis is a tender business. So if the tenders don't open on time, then the demand will not be there. But at the end of the day, the number of patients across the world remain where they are. So the demand is going to come up, whether it's in this quarter or next quarter. So I think very difficult to right now say that it is only because of rifampicin that the demand is going up, or rifa demand is going up. But we saw a reasonably good trend over the last 2 quarters in terms of demand of both the products.
And so for the second half of the year, are we seeing a similar uptake as of now, or is the volume growth more of a short cyclical stocking, as you mentioned? Are we seeing some moderation on that part, or are we seeing a good growth as of now as well?
I think when we had the last meet also, we said that one thing that we will not do is speculate in terms of how the next 2 quarters look. So we can we are very happy to talk about what happened in the last 2 quarters and give you broad perspectives and plans of what we are planning strategically going ahead without discussing about what numbers or what quantities we are going to sell in this current quarter or the quarter after. I hope you will understand.
Yeah, absolutely. Just one clarity. So on the rifampicin, we are exposed to some tender-related cyclical highs and lows, but rifaximin is a fairly stable business. Is that the correct understanding?
Rifaximin is a fairly stable business, but when we sell Rifa-O to a customer who converts it into rifaximin and sells it to other parts of the world, there's a lot of turmoil that is happening across the world, right? In terms of currencies, in terms of dollar to their local currency. So sometimes the demand may be there, but because of reasons of debtors, etc., you may have a variation in terms of quantity supply from one quarter to another quarter. So I think it's not possible to say for sure that it's going to be this way or that way, but I think at the end of the day, the demand is there, which means everything evens out.
Sure, sir. Thanks a lot, sir. That's all from my side.
Thank you. We have the next question from the line of Sachin Shetty, an individual investor. Please go ahead.
Yes, sir. Congratulations for a good set of numbers. Sir, my question is for this fermentation plant and API plant. So what I understood from last call, so our these projects, I think it will come online in next year, FY24 quarter 2. So how much capex, how much project cost is for the API plant and fermentation plant? So this is the one question. And second question is, so once it comes on online, so what are the regulatory approvals are required for the fermentation and API plants? And which are our markets? ROW is our market, or we are going for the USFDA? Thank you, sir.
May I request if Mr. Rajneesh Anand can answer? The line of the management has been disconnected, so I'm trying to connect them. Give me a moment, sir.
Okay. So these products will have markets everywhere. The products we try to pick up, we essentially ensure that they should also have a good domestic market. And of course, they have potential for ROW and regulated markets too. So the idea is that once the plant gets started, you are able to do some business while you do all the regulatory, validations and filings and everything. So that is it. On the cost part, we expect the API plant to cost us about 40 crores.
Okay.
And that's it.
Fermentation. And fermentation. Fermentation,
we will have a phased investment, and therefore, it will be like we actually plan to do about 3 plants together, but in a phased manner. So that will be over like 2 to 3 years, as we have told earlier.
So how much we have deployed, how much capex we have done for this, whatever the fermentation plant till date?
Fermentation plant, we have not done any capex so far, but the project is under planning, and we actually plan to, start digging the soil by next month, by December.
Okay, so 3 blocks will be constructing only for the fermentation plant, right?
Yes. But we will construct them over a phased manner.
I understood. It's a phased manner. And 40 CR for the API plant.
Yes.
And market where we have identified for the API plant is ROW and emerging market. We are not going for the USFDA, right?
No, we will also go for USFDA.
Okay, understood.
That's going to be completely GMP facility.
Okay, sir, understood. Okay, sir. Okay, that's my message.
Thank you. As that was the last question for today, I would now like to hand the conference over to Dr. Sachin Patel from Gujarat Themis Biosyn Limited for closing comments. Over to you, sir.
Thank you. Thank you very much. So finally, I would like to thank the entire team of GTBL for their untiring efforts and hard work and dedication. This is what drives the company forward through various market conditions that are there around us. Also, I very much appreciate all of you for participating in our conference call. Needless to say, please do get in touch with our investor relations teams for any other questions that you may have. With that, thanks very much.
Thank you. On behalf of Gujarat Themis Biosyn Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.